Hello everybody, and welcome back to another video on financial analysis. And today we are going to be looking at Camellia Plc. Now, if like me you've never heard of Camellia, then let me enlighten you. Here we are. So Camellia is a United Kingdom based company operating in agriculture, engineering, food service, and investments. Company segments include agriculture and engineering. Agricultural sector segment is engaged in the production of core crops, including things like macadamia, avocados, and loose leaf tea. So this is a request, by the way. So if you're wondering how come I'm doing this and having not heard of it, we had one of our subscribers, Phil. So Phil sent me a message saying, can you do a video on Camellia, and then gave me a little bit of extra sort of background. I wanted to recommend it. Says no stock dilution, insider ownership, refocusing its business away from distractions. It's sold part of its business, the cold food storage, has investments in an insurance company which has had a tough year, and slowly growing revenues, decent earnings, so might be worth a gander. So, well, Phil, I am having a gander, and here is your gander. So without further ado, let's jump in and have a look at what the numbers are telling us. Now, remember, when we're looking at the numbers, I'm not familiar with this company or this sector. So here is the financial report. It's 2021, so it is a little bit out of date, but it does give you lots of information about who the company is, what they do, who's in charge, the kind of the experience of the directors, etc., etc., and lots of other information. However, I'm going to whiz through all of that. You're perfectly capable of reading that if you want. So I'm going to whiz through that all the way down to the income statement, which is where we are going to start. And here we are, the income statement. So we are dealing in pounds, in millions of pounds, and the first thing we notice is that the revenue is 277 million pounds. Now, I wouldn't worry about this kind of, often companies kind of, have these two columns of, normal business and then other bits and pieces, and quite frankly, I just, I go straight for the total column. So, we're really comparing the total column for this year, and we're just comparing it to the total column last year. Sales, you'll notice, are down. Okay, so sales have fallen by about 5%, which is not sort of the best start in the world, but so growing revenues, well, I'm suggest that maybe the revenues aren't growing quite as much as they would expect or like. Cost of sales represents about this number here represents about 78%. Okay, so it's quite a low margin business. The gross profit is only 62 million on sales of 277 million. They've then got the cost, the distribution costs, and the admin costs, and that effectively leaves them with a profit, an operating profit of about 7.7 million pounds. So it's their trading profit here. You can see the actual trading profit. This is kind of the core business. They're making, that's basically break even. It's 900,000 pounds. It's a kind of £1 million. I mean, it's better than a loss in the previous year, but it's it's not looking too good. They then got this associates, so they're getting some share of associates results, and that's kind of keeping their head above water, I guess. That's why they're making a profit in both years, but they're only just making that profit. And then we've got kind of profit before tax, and then the net profit down the bottom. Finance costs, these numbers here, this is the interest that they're paying. So they're paying interest on operating profit of 7.7, and that 7.7 is driven by the share of the associates. So if they didn't have that associate, they wouldn't have that 7.7. They wouldn't be able to pay their finance costs. So these guys are, they're really not making a lot of profit. It was basically kind of break even negative in the previous year. They lost 800,000. This year they're at 4.5 million, which is a 2% net margin, and is really, really tight. So this is probably one to watch, this finance costs. And we just want to make sure that, if we live in a world of rising interest rates, we don't really want to be seeing that number increasing too much more. It has been increasing. It's either increasing because interest rates are going up, or because the amount of debt they have has been going up. We will have a look at the balance sheet and see if we can find out why. So there we go. There's our income statement. Not a lot of profit going on there. Let's go and have a look at the balance sheet. So here is the balance sheet. Looking at the assets, first of all, we're on the left-hand column. So total assets is down, quite interestingly. And non-current assets has gone up, and that the biggest number in the non-current assets is the property, plant and equipment. And you know what we should do is we'll just use the number below that as well, which is the right of use assets, which is property, plant and equipment, which is on a lease or hire purchase, so to speak. And that often helps a cash flow rather than having to buy something outright. Now we just lease it over the forthcoming period. There's the investment in the associate, so that is sort of generating that 7 million of income, and that just means that you know, they own, you know, part of this business, but they own less than 50%. If they own 50%, it would be a joint venture, and if they own more than 50%, it will be consolidated into these numbers. Non-current assets, 412 million pounds. Current assets, lots of inventory up there. Trade and other receivables, and there's the cash, and we can see the cash has gone down by about 40 million. We'll have a look at the cash flow statement to see if we can determine why it's gone down and whether that raises any warning signs. Looking at on the bottom half of the balance sheet, the liabilities, the current liabilities, 83 million. So current assets, total current assets 181 million, liabilities 83 million. So liquidity on the face of it doesn't look a problem at all for these guys. So even if we look at the acid test and eliminate stock, so current ratio, current assets to current liabilities, 2.17 for every pound they owe and have to pay soon. They've got £2.17 either as cash or coming in as cash soon. And if you eliminate inventory from that calculation, which might be worthwhile, then it's at 1.55. So still looks pretty healthy. So the trade and other payables really, you know, looks pretty reasonable. You know, it looks to me, back of an envelope calculation, it takes them 84 days to sell their inventory. Sounds quite a long time. Takes them another 61 days to collect the money in from their customers, and they pay their suppliers in 91 days. That kind of basically adds up to them paying the money out before they get the money in terms of 53 days. So, you know, there's a bit of a sort of strain on their working capital, but not massive. But it looks to me like these guys do have enough working capital. So these kind of numbers here are looking reasonably healthy. I can't see anything that's kind of, you know, causing me concern in those numbers. And you know, they've got enough cash to pay their suppliers. So that's fine. You know, and the previous year they certainly did. Non-current liabilities, quite interesting. So very little in terms of the borrowings. You'll notice the borrowings are actually quite low. And you remember all that interest we saw? Well, it looks to me like the interest is mainly the lease liability. So those lease liabilities have been going up. And so in effect, you know, we can see there the right of use assets has been rising. So these guys, they're not really buying assets. You know, there'll be a little bit of depreciation in there, but they're really leasing their assets. So they're kind of, you know, conserving cash, leasing assets, and they're paying interest on those leased assets. So balance sheet looks in reasonable, you know, looks reasonably healthy. Net assets are 437 million. Okay, not a huge amount of debt sitting there. You know, everything looks okay. No red flags from my perspective anyway. Let's have a look at the movement in equity before we do that. So retained earnings, these guys are, you know, interesting enough, they're paying a little bit of a dividend. So there's a dividend they paid in 2020, or sorry, during 2021. And you know, quite an interesting, yeah, it's you know, paying a dividend. I'm not sure why they're paying a dividend. It seems to me like, you know, they're not really making a huge amount of profit, and it suggests that maybe they're struggling to afford that dividend. Dividends in the previous year, 2.8 million. Dividends in this year were 5.2 million. So not a massive amount of a dividend, but they are paying dividend. There you go. let's look at the cash flow, which is obviously a very important number. And here we probably see our first red flag, which is this number here. There's a negative 12 million cash flow. Now that is driven by paying your taxes, but you got to pay your taxes. And what we see here is that net cash flow from operating activities is only £2 million. Now, because of the way these are presented, we need to look at note 37 in order to understand that number in a little bit more detail. Okay, so typically companies will show the kind of reconciliation of operating profit to cash profit on the face of their cash flow statement. Under UK GAAP, you don't have to do that. So if we whiz very quickly all the way through these accounts to note 37, sorry. So we find note 37, and we will find that reconciliation of that cash flow statement. And here it is. So note 37, so there's the profit, 7.7 million, and there's the net cash flow. So again, don't forget, profit is pretty small. And they add back depreciation relatively small. That's a non-cash expense, so we're adding it back to the profit. And then we kind of see, well, what are the sort of the big numbers? So there's a big movement in provision. There's an increase in working capital, so a bit of extra cash tied up in working capital. So there's nothing kind of really massive in there. It's just kind of, they're not really making a profit, and they're not generating cash, and that's kind of an issue for them. And it's a bit frustrating. I think the balance sheet isn't saying we're about to go bust or anything. There's nothing kind of no kind of big warning signs, but they're just not generating cash. And so if you're generating negative cash from your trading operations, and you're trying to invest in the business, and the investment is pretty small, so they're not really investing. Look, there's the proceeds from the sale of investments. Okay, so that's the divestment that we were mentioning earlier, and they've used that money to, they're buying property, plant, and equipment. That's really what's going on there. And they've bought a few more investments, you can see just here, but they're really funding their kind of their property, plant, and equipment through the sale of investments, it appears. And then they are from the financing, they are paying the dividends. There's the dividends in the top line. They're doing some refinancing. You can see the loans repaid is lower than the kind of the new loan. So it looks to me like they're trying to pay down their loans as well as pay off their dividends. And that's why that the cash at the end of last year, 95 million, is only 16 million this year. So they made a cash loss, and they are trying to pay down their loans. So they're trying to keep their balance sheet under control. I guess my concern, not really a red flag, is just, it's a very lackluster P&L account. They're just trading at break even. They're not really making money. They're not making money. They're not generating cash. They're just staying alive. And I wouldn't really classify this as a zombie company, but it certainly doesn't look like it's, I'd be interested to know how exciting the story really is for these guys. Let's have a look at the share price. Here is the share price. So market cap is 135 million pounds. Interesting, they don't give a PE ratio. I don't know why they don't give a PE ratio, because under my calculation there is an earnings, and if you've got 4 million of earnings and you're worth 135 million, then you're trading on 30 times earnings, which I think is quite a lot for this company. I have to admit, I think that sounds quite expensive if you're on 30 times earnings. That's a yield of about 3.3%. Dividend yield is 3%, and again, how sustainable is that dividend if they're not really making profits? I don't know is the answer to that. So it's not something where, this doesn't have screaming buy. I'm not sure it's necessarily got screaming sell either. If you remember the balance sheet, the balance sheet's got 437 million. So, theoretically, and I emphasize the word theoretically, you could buy this company for 135 million. sell off all the assets, pay off the liabilities, and you'd end up with 437 million, which would give you a profit of 302 million. So this is trading at below book value. So, you know, Phil, you know, when you say it's unloved, it certainly is unloved. It does look cheap, but I think it's cheap for a reason, and I don't think it's going to go to zero. I'm just, you know, I'd be interested in the story as to, you know, where the growth is going to come from, how they're going to start making, you know, making profits, generating cash, reinvesting, and, you know, really, you know, delivering on, you know, what they're, you know, what I guess the investors are looking for. So it's cheap, you know, it is cheap on a book value basis. You are buying, you know, you're buying it at a quarter of its net asset value, although, you know, your due diligence may sort of uncover a few gremlins and decide that the net assets are not actually worth 437 million. So there we go. We'll just have a quick look at, we like to do this, a quick look at the CEO and compare the CEO to our average average employees. So the CEO is Malcolm Perkins, and you will find his remuneration report, well, of all the directors on here we go on the remuneration report. So we can see Malcolm Perkins total remuneration and benefits in kind came to, in 2021, came to in fact we don't we want to be looking at Tom Franks, looks like the highest paid. So if we look at Tom Franks, he is on 650. So he's doing pretty well, 650,089, and the previous year he was on 650,273. So it hasn't really seen much of a pay rise there, but still doing reasonably well on £650,000. You know, certainly not the highest paid on the you know, directors of these types of companies. Just to look at the employees, if you want to look at the employees, the numbers are actually in the account. Quite an interesting number, this one. So you can kind of see whether you're above or below average in terms of the pay. So here is the employees. So we can see for 2021 the total number of employees is 78,000, and their pay amounted to 117 million pounds. Okay, that's 117 million pounds. Now, if you take 117 million pounds and you divide it equally between 78,000 people, by my calculation, each person is going to get £1,490 each. Yep, that's about £1,500. Now, I'm sure there are going to be some people in that group who are paid more than £1,500. That's a year, by the way. That's the total year, and therefore there'll be some people who will be paid considerably less. So Tom Franks is on 436 times the average salary. The average salary for this business is £1,500, which sounds very low to me. Now, it may be that you think about the kind of the employees by activity. It's all in agriculture. That it doesn't tell me whether that's UK agriculture or overseas, and it could well be, you know, farms, you know, overseas. I know that they do have some overseas. You can see they're kind of talking about overseas benefits, for example, and maybe these are people who are paid, you know, considerably less to till the land in far-flung places. But it's just a bit of an eye-opener. It kind of surprised me, and maybe it surprises you. So there we go. There is Camellia Plc. I hope you found that useful and informative. Phil, I hope you found that useful as well. It's cheap. It's cheap for a reason. I can't see it. I wouldn't put it on my short list. I don't think it's going to kind of, you know, cough and splutter and then sort of fall out of business. I'm not sure it's necessarily on my buy list. I can't see the kind of the excitement, but I may be wrong there. I don't know what the story is within the business. I don't know what the story the directors are giving the shareholders, but it looks to me like a company that's just kind of limping along at the moment, and is, you know, running at break even, not generating cash, not really making a profit. It's got a reasonably strong balance sheet, but you know, the cash has gone down, and we don't really want that cash to be going much further down before we start having a few alarm bells. So thank you very much indeed for watching. I hope you found it useful. Please don't forget to like, share, and subscribe. Click the subscribe button, and I look forward to seeing you on the next video. Hello, thank you for watching that video, and I hope you found its contents useful. If you want to know more about what we do here at Talk Financials, you can find out on talkfinancials.com, where we will explain how we design, develop, and deliver training workshops for companies all over the world. We've worked with over 300 companies in over 35 countries around the world, helping them to understand financial statements, to understand business finance, and to become fluent in the language of business finance. If you're interested in developing your own skills in how you read and interpret financial statements, I've developed an online workshop which is available. All you got to do is click on the QR code there, point your camera at the QR code, and that will take you through to an online workshop, and it will help you to improve your own ability to read and interpret financial statements. I've also written a book called How to Talk Finance, and again, that is available. If you click on the QR code, it'll take you through to the Amazon website, where you can buy the book either as a hard copy or as a Kindle edition. And that's really everything from me. I'm on LinkedIn. It'd be great to stay in touch. If you'd like to contact me, then again, just click on the QR code and send me a message. And good luck with your financial analysis. I hope it goes well.